What is good, everybody? Today is July 31st. We're going to be quickly running through price action, see what happened, how we could have used market maker principles to take advantage of this crazy move today, and how I marked out a counter trend long that unfortunately I wasn't able to hop into because it was past the time that I hopped off the charts. But there's no problem in that because when we follow our system, we set ourselves up for a consistently rising equity curve that goes and extends into years into the future and not just one day, like sticking on the charts a little longer would have got me today. So without further ado, let's just get into this trade. So y'all know the most important part, bro. We're gonna start with that top down. I think today is super important to analyze the narrative in price and watch how yesterday we had FOMC give us a really nice short, and then the overnight session and the aftermarket close session just literally completely pumped to the upside. Super unexpected move, super interesting price action, but we have to recognize that when we open the market and we see this kind of overnight pump, we have to recognize that trading today is going to be lower probability. If the market moves literally, shoot, I don't even want to go past this, however many points this was, bro. If the market gives us that kind of movement, we have to understand that we can expect an eventual rebalance, but we don't expect to see high probability trades just playing out and formatting easily like this. Like if you look right here, we had our entry model right here, inverse for value gap, change the state, everything, and it banged on the 1 hour. However, why didn't we just instant wake up and short? Well, there's logistics involved with that, right? And that 1 hour change of the state is not going to override this huge fair value gap right here, and we're not expecting it to. So instead, how can we analyze this and see how to frame a trade off of it? Well, waking up, we wake up about a little bit right around here at 9:30. Market opens and immediately is dumping. Like we are dumping at 9:30 and before 9:30 even. So 9:30 opens at this point right here. Now keep in mind, at this point we had completely already ran through. We had taken Asia highs and we had taken London low, and now we're looking to just go ahead and run to Asia low, right? So Asia low is sitting somewhere around here, I believe. And there's also a new day open gap right there. And right when we tapped this level, there was no reaction, right? So we're already super sussed out to take a potential long. And although this bigger time frame is definitely a short bias, we have to understand that trading in this and taking a short would require us to pull way back to a premium, so potentially into a fair value gap like this. And we have to do this before we hit what we suspect to be our target to potentially bounce for longs off. Because we understand that if we're going to trade short, we need to get involved in, we expect this to happen, right? After this push higher, we expect to see a slow rebalance and a tap point and then a go, right? So if we want to get involved in shorts, we have to get involved during this point, not during this point, right? Because what we think to be a pullback will actually be the displacement higher, and then we'll just completely push against the trend, right? We want to take a short within this right here, right? So somewhere right about here, targeting the downside, not wanting to take a short right here where we think this is pushed lower and ends up just completely invalidating us. That's what we have to respect and understand, right? So when we tap into this Asia low and we tap into that new day open gap, for me, shorting is incredibly much lower probability now because we had tapped into a point where we could potentially see a reaction off. So we want to be careful with our shorts. If it's going to play out, if it's going to work, we have to be very careful. We have to wait for extra confirmation, right? Another thing to add, which I really liked here, was if we're going to rebalance and we have so many inefficiencies on the left side, we're most likely going to pull to equilibrium and react off of there, right? So drawing an equilibrium would look something like this today. That's what I did right in the morning session, right when I woke up. This is the first thing I popped on the charts because I just recognized it was perfect for this huge range that we developed in the overnight session. So drawing an equilibrium right here. So if we look, we see right until pretty much, an hour or two into the day, we just continue pushing for shorts, We have this initial morning rebalance around 9:30, going into 9:50 macro. This was a really okay opportunity I saw a lot of people take, but the reason I didn't want to hop in on a 1 minute chart here and play a long right here, looking something like, wherever you can get your entry here, that's another reason there really wasn't much entry here, right? So even if you placed a fair value gap, you most likely didn't get tapped. And you could have played this to, I probably would have played this to internal high right here, barely got tapped. But the issue here is, number one, our R is not the highest, so we expose ourselves to a less risk reward trade, which is always not the best conditions. And as well, watching this play out, you can tell there's discorrelation because at this point right here, this high is 934, right? And we take this on ES at 953, and at 953 we already displaced through this. Looking at ES, it immediately slows down. We see discorrelation, right? And if we look here, look at the size of this imbalance right here. We have huge imbalance price action all through this range, where on NQ, we create that same imbalance price action, but we go ahead and rebalance to it. So now that leg becomes a generated liquidity leg, right? So look, right here on NQ, what this becomes is a bigger imbalance right here. When we see this imbalance form, and then we see that little mini pullback, that high right there does not become generated liquidity. It simply just becomes the low of that imbalance on the bigger time frame, right? And if we zoom out to the perfect time frame, we'd see that. But just looking at the price structure and understanding how price develops, you can see that, right? So if you look right when we tap that high, we end up pushing lower because that's our new imbalance, right? So looking on NQ, we don't do that. NQ creates that imbalance price action, and then it goes ahead and pushes all the way through the range, pretty much taking most of that imbalance price action away, filling all the orders that are in there that price needs to fill to efficiently move back to the downside to where the next efficient area for price to react off of is. And then it continues lower, right? This now becomes much more just simply pattern recognition, guys. This becomes much more like generated liquidity right here. Generated liquidity. What's looking more like generated liquidity, y'all? Let me just pull this over here. What is looking more like generated liquidity, y'all? This kind of area, when we're looking to take a long opportunity, if we see generated liquidity right here on these three highs, is this looking better, or is seeing something like this looking better? Was a complete imbalance and then we push higher? This is not good to me because we are longing into bearish order flow. That's not what we want to do. That's why this trade wasn't good in my opinion, but it's interesting to still look at how on NQ, when we created this generated liquidity, we ended up running higher into price, running back into this fair value gap. Hold on, boys, I have these switched. 1 second. Yeah, my bad on that one, guys. I have this completely switched around. I'm used to NQ being on the right side here. So now looking at price, when ES goes ahead and generates that liquidity, it can run it. But if you look, NQ did not generate any liquidity. And in fact, it just placed it imbalance. So we rebalance to that leg, and then from there, we push lower. So this move on NQ was to rebalance, and this move was to hunt liquidity. We can see that because this generated liquidity. When we generate liquidity, we will usually hunt it. If we create an imbalance, we generate an imbalance, we usually rebalance to it and then hunt liquidity to the opposite side, right? So if you look, how could you have framed a trade, right? You could have seen, you have SMT, SMT, right? Now you could have looked for internal SMT. I don't believe there was any. And you could have taken an entry just straight off of this first change in state right here. First for value gap, taking a low, 3.41R, leave for runners. And I mean, this would have been the play today because honestly, checking out this range, this could have been a crazy move. But that's really optimistic trading, and it's disregarding the opportunity that price could rebalance. Because to me, there is no reason that price should run through all of this order flow. Seeing this crazy move back to back with this crazy move is super unexpected, so that's why I don't really care about it, right? So where would my system have been applied today? And it's pretty cookie cutter, I'm not even gonna lie. So looking at this range, we see NQ is looking a lot more bearish than ES is, right? ES is still kind of holding up, right? And at this point, right when we tap equilibrium, we see a reaction at 11, and NQ had already pushed way through equilibrium, pretty much looking bearish while NQ is looking bullish. So a little bit of discorrelation, but it's important to watch how right when we tapped equilibrium, we reacted on ES. So just zooming in right here, we tap equilibrium, we react, we manipulate lower or continue the trend, whatever you want to see, and then we displace through and create a change in the state, right? So where did I get involved? I was ES, right? I took this 5-minute change of the state, and when I see 5-minute, this is too big of a time frame right now, especially with this bearish order flow, for me to want to actually take a long just on the 5-minute, right? For me, it's always going to be higher probability to not do something like this, and instead, watch this. I'm going to scale in to whatever time frame looks the cleanest. And after I see that change of the state, I'm going to look for that internal model, which is the same exact thing that I'm looking at in the 5-minute, except we get it on here, right? So right here is where you would have taken your entry, change the state, inverse for value gap, displacement through. You get tapped eventually on this change of the state. TP goes here, stop loss goes here. First take profit is a 1.56R. This is where I take most of my position off of, because a lot of the time you'll see this get tapped, you'll see a move higher to hit standard deviation 2. So just quickly marking this out. I don't really, here, right here. Standard deviation 2 is right here. So, I mean, this wouldn't really apply that best, right? I'm gonna put it here. I mean, yeah, look, we got almost tapped the standard deviation too, and we get pullback. Most of the time, this pullback will stop you out. So this one right here usually stops me out of break even and then continues without me, right? So that's why I like to take 50% off, put stop to break even, and let the runners go, right? So the way I would have managed this, the way I was managing this in class, because I had to hop off the charts right about 8:10. So for me, that would have been 11:10 right here, right after last this macro. This kind of played out, and I opened the charts somewhere about right here, and I was like, holy shoot, beautiful setup. It's going for runners right now. So I would have held this first to this take profit, 50% off. Next to here, probably taking 20% off. And then finally, either to this level or to this level, which I thought was a crazy top take. This was what I was eyeing in class. And I mean, looking at this setup and this model plays, dude. This is internal model, leaving this for runners. This is a consistent system that will print you. And a lot of the time it is present. It is always going to be present. If there is a market maker model that plays out at least the 5 minute, a lot of times you can get a really nice internal model trade. Really nice internal model trade. But one thing that I'm changing in my trading is I review my journal and review my trades. I notice a lot of the time that most of my losses come from when there is a 1 minute model, and then I zoom into the 5 second. And the most interesting thing about this to me is that a lot of the time you see the 5 second trades not actually playing, the 5 second internal model is not actually playing out. So let's try this, right? Let's zoom into this 1 minute model, right? Where you see this 1 minute model playing out perfectly to the downside. So yeah, after this top tick, I probably would have got stopped to break even right here for the last 10%, 20%, whatever's on, right? But let's zoom in and let's show why that 15 second ends up working, but the 1 minute and the 5 second combination really never works out, right? So change the state would have been right here, got tapped perfectly. Zooming to the 5 second, this is super interesting. The 5 second, in my opinion, is way too low probability to actually be taking trades off of. In my opinion, it fakes out too much, it runs too hard, it moves too quickly, and it's not even a matter of reaction time. It's simply just a matter of it doesn't provide a pullback to give you a re-entry, right? So looking right here, your change of the state on the 5 second, and I know this is ES chart, so it is horrible, would have been after this, you would have got pulled back to hit right here, which in my opinion, if the model starts moving like this, it's not a good sign, because when we start slowly rebalancing, we're most likely going to come take this high, and we most likely made an SMT. Be interested to check that out. So high right here, no SMT, interesting. But most of the time we will end up taking this high and then continuing lower. So because of that, taking these 5 second trades when they're so inefficient like this is really never the best opportunity. I mean, yeah, it would have played. You could have got a similar R to the one we took before and then left for major runners to the downside. Whatever you want to do here, great trade, bro. I'm glad you took it. But for me, in my experience, the 5 second internal model trades are always going to be lower probability. In my opinion, if you're a second trader, just stay off the 5 second chart. The 15 second chart provides much more opportunity. And let me show you guys a little secret that I've learned from trading. If you see and you want to take an internal model trade, don't try to time frame align, because many ICT traders out there, they say stuff like, when you see an hourly liquidity sweep or an hourly fair value gap, zoom to a 5 minute chart and take the trade on the 5 minute chart. That, in my opinion, is not right, because they're trying to find the right time frame that shows market structure in a clear way that can simplify it for a person who does not understand market structure to then be able to take a trade. It's a fix for a problem that you can fix just by fixing the problem. And the fix to the problem is just understanding market structure. And when you understand market structure, you know when the market's expected to go ahead and react. And because of that, I can be a 1 second trader. I can wait for the exact same opportunity, for the exact same point in which I expect price to start acting efficient, and then I can wait for displacement, not looking at the first change of the state, not looking at the most recent swing high, but I can look for the level that actually shows me structural displacement through a significant low in terms of the model. This is some sauce, and I know not a lot of people are actually going to stick around and listen to this, but understanding market structure is the holy grail, and trying to take things like, I'm just going to take the first presented for value gap, stuff like that, and just only look at the 5 minute chart because it's simple and my mentor says it works. It most of the time is a cheap cop out for really just understanding the truth. And I hope that you guys will understand the truth. Like, look right here, 1 second chart. I know it's horrible. Your first change of the state would have been right here. This doesn't get tapped, because the 1 second and the 5 second are just too granular to actually show these nice internal models. You want to be checking out and looking, where's the actual structural displacement in terms of this model right here. Look at this as a line chart. This is sauce. Look at this as a line chart. this market maker model right here, this one right here, with a sell curve sitting right here into a change in the state and a fair value gap, and the buy curve out of it, where do you actually see the structural displacement? Where are your standards placed that when you get displacement through that level, you now are confident that we'll go to buy side or we'll go to sell side? For me, just looking into this, the displacement that I want to see is probably going to be through either this high, which could definitely be too early, or through this high, right? And we end up getting the displacement through both of these before the market pulls back, right? Market never pulls back and taps this high, which tells us this is too internal for this model, right? If the model is, look, if the model is this size, oh my gosh, I'm gonna share some sauce right now. If the model is this size right here, look at this line chart. If the model is this size, if this is the model that we're trading, you can see the change in the state here in the structural level that we want to see displacement through is going to be this level right here. Look, taking a short right here. If we want to see displacement, if we want to take the short right here, that structural level, when that gets placed through, that's now we're changing the state. So now we can put stop at this high, and look how the market pulls back to that. That's because that level, that swing low, is in context and is big enough and important and relative enough to that internal model that the market pulls back to that to collect its liquidity and then run that sell side. It has to be in terms of the model, of the market, right? Of the time frame, of the smallness, of the size, of whatever model you're trading, right? Understand that. And look, this high is too small to see the market pull back to. That's why it rips through that level. And then it continues ripping, rebalances, rips through this level, and then rebalances to both of these. Now we have order block, breaker block, right? We rebalance to both of these, and then we continue from there. That's what the market wanted to do. This high was the one that actually mattered enough for the market to go ahead and take it, right? And if you look, the change of the state would have been somewhere right here. So right when the market does pull through that, it pulls back, taps you, and goes. Understand, market structure is the king. Taking things like time frame alignment is a cheap cop-out, which is why I say, when I'm looking here, I'm not like, okay, I see a 5-minute change of the state, now I zoom into a 30-second, or now I zoom into a 15-second. I zoom into whatever's clear enough. And honestly, you want to be taking the highest time frame that is completely clear. So the 30-second here, this doesn't provide enough clarity. The change of the state would be right here, and when that happens, it's just way too early, right? I want to go to the time frame that looks that is the highest possible time frame that still shows me that clarity and shows me what I need to see to take a trade, right? So zoom into the 15-second. Tell me why the 15-second is perfect for this. It's simply just one step down. It's just one step down, but it shows me the perfect thing I need. It shows me that fair value gap, that final manipulation leg, the new fair value gap to get opened up, and it shows me that perfect tap back into literally almost a zero drawdown trade, into touching that order block, which is the change of the state, stop, take profit. Beautiful internal model trade right here. You can't get better than this. Leaving for runners, leaving for runners. You really cannot get better than this. And this system, bro, like, I'm sitting in class watching this play out, blessed, because this system is so accurate. These standard deviations for runners, this internal model leaving for runners is so, I mean, look at this move. This was top to bottom of a move. This was perfect. This is what this system provides you every single day. If you want to learn more, watch my trade recaps, watch my tutorial videos, and you will see what I'm talking about. This system is a never-ending provider, continues giving. It is a beautiful system, and if you just follow it, you will see profitability. Thank you all for listening. I love you all so much. Hope you guys learned something today. If you found anything about market structure and market maker models interesting, check through my page. I have a ton of videos on all of them. Go over my trade recaps, stuff like that. Thank you guys for listening. I hope you guys learned something. And if you have any comments, just drop them in the comments, and I'll catch you all later. Peace out.